If you've been watching the markets this week, you probably noticed something that just entirely defies the basic physics of Wall Street.
Oh, absolutely. It's been wild.
Right. Usually, when a publicly traded company absolutely shatters its financial targets, there's a predictable script, like a really comforting cause and effect.
Yeah, the earnings drop, executives take a victory lap, and the stock goes up.
Exactly. But then you look at what just happened with Broadcom's Q2 2026 earnings, and well, the laws of financial physics seem completely broken.
They really do. It's a total paradox.
We're talking about a tech giant reporting record-breaking revenue, crushing profit targets, and casually announcing a $30 billion backlog. And what did the market do?
It panicked.
Right. The stock
Look.
plunged 15% the very next day.
Which is just, the absolute definition of a market paradox. What you're seeing there is a classic collision between stellar physical business reality and these sky-high, almost science fiction level expectations.
So today, our mission is to unpack that paradox. We've been poring over the Q2 earnings call transcript, a really candid Bloomberg technology interview with Broadcom CEO Hock Tan, the raw financial results, and some CNBC reports to figure out what is actually happening under the hood.
There's a lot of incredible data in there to go through.
There really is. But before we get into the mechanics of all this, we have a standard reminder for everyone tuning in. All the information and analysis we discuss here is just to help everyone better understand the market, and it is not investment advice.
Yes, very important. Investing involves risks. Please make sure to do your homework before entering the market or, consult a professional financial advisor.
Exactly. We're here to analyze the underlying tech and the strategy, not your portfolio. And to truly understand that strategy, we have to first look at the sheer scale of the financial numbers Broadcom just posted.
Because they really paint a picture of a company operating at an unprecedented level.
They do. So let's translate some of these raw numbers, because just reading off a GAAP balance sheet can be a bit overwhelming.
It's a lot of alphabet soup sometimes.
Totally. So total revenue hit a record $22.2 billion for the quarter.
Which is up, 48% year over year?
Yeah, 48%. But the metric that really jumped out to me is their adjusted EBITDA. That hit a staggering $15.2 billion.
That number is just crazy.
Right. And for anyone listening who isn't buried in finance textbooks every day, EBITDA is essentially the actual cash profit a company generates from its core operations. It's before the accountants start moving things around for taxes and depreciation.
Yes, the raw cash engine.
So if I'm doing the math right here, on a $15.2 billion profit against $22.2 billion in revenue for every single dollar Broadcom makes, they are keeping roughly 69 cents as pure operating profit.
Your math is spot on, and I cannot stress enough how rare that is.
Really?
Oh, yeah. That kind of margin is almost unheard of when you're dealing heavily in the physical manufacturing of hardware. Those aren't just good quarterly numbers. Those are like generational wealth-building numbers for a corporation.
Mm-hmm.
And the engine driving that insane profitability, as you might guess, is entirely artificial intelligence.
Yeah, the AI boom. The semiconductor segment alone brought in $15 billion, which is a massive jump.
Huge.
But within that segment, AI semiconductor revenue specifically hit $10.8 billion. That is up an incredible 143% from last year.
It's exponential growth.
Okay, so I have to play devil's advocate here. If you are doubling your net income, keeping 69 cents on every dollar, and your core AI revenue is exploding by 143%, why is Wall Street punishing you?
It's a great question.
It seriously feels like penalizing a high school student for getting a 99 on a final exam. What are the analysts seeing that we aren't?
Well, they aren't seeing a flaw in the business itself. They're suffering from the hype cycle.
The hype cycle.
Yeah. Wall Street is currently grading AI companies on this terrifying, almost impossible curve. They don't just want steady, massive growth. They demand constant exponential acceleration.
Oh, I see.
So the disappointment that triggered that 15% drop really stemmed from two highly specific expectations. First, the infrastructure software side of their business came in at $7.18 billion, which slightly missed analyst estimates of $7.32 billion.
Wait, we're talking about a miss of a fraction of a percent of their total revenue.
Right.
That simply cannot be the main reason investors panicked and wiped out billions in market cap.
You're right. It wasn't the main catalyst. The real issue was the long-term forecast.
Okay, let's hear it.
Investors desperately wanted CEO Hock Tan to raise the company's long-term 2027 AI revenue projection.
So what was the original target?
Broadcom had previously stated they expect to cross the $100 billion mark in AI semiconductor revenue by 2027.
That's a massive number.
It is. And during this earnings call, they reiterated that target. They didn't lower it by a single dime. But because Hock Tan didn't get up there and declare, actually, let's make it $120 billion, the market threw a fit.
I feel so completely disconnected from reality.
It really is.
It's like watching an athlete run a marathon in record time, but the crowd boos because the runner didn't invent teleportation at the finish line.
That's a perfect way to put it. The expectations have become entirely detached from the physical limitations of building these complex systems.
So if the market's expectations are detached from physical reality, let's look at what that reality actually is. What is Broadcom physically selling to hit that $100 billion target?
Because it's not what people think.
Right. Because when most people hear AI hardware, they immediately think of NVIDIA GPUs powering ChatGPT.
Exactly.
But Broadcom isn't really fighting NVIDIA head-to-head in that specific lane, are they?
No, not at all. They are taking a completely different, highly specialized approach. While the rest of the world focuses on general-purpose GPUs, Broadcom specializes in XPUs and TPUs.
Okay, I'm going to need a quick translation on those acronyms.
Right, sorry. So a TPU is a tensor processing unit. It's a custom-designed chip built from the ground up specifically for Google's infrastructure.
Got it. And an XPU.
An XPU is just a broader industry term for any custom AI accelerator.
Okay, so how is that different from a GPU?
Think of a GPU, a graphics processing unit, like a highly skilled, versatile multi-tool. It's a genius piece of hardware that can perform 1,000 different complex calculations really well.
Like a Swiss Army knife.
Exactly. An XPU, or a TPU on the other hand, is like a surgical scalpel. It is a custom-tailored brain built exclusively for one highly specific task, like running a massive language model for a single enterprise client.
Oh, okay.
Because it doesn't have to be good at 1,000 different things, it can be vastly more power efficient and faster at its one specific job.
So Broadcom is essentially offering bespoke custom tailoring for tech giants, while others are selling off-the-rack high-end suits.
Precisely.
But here's the part of the earnings transcript that genuinely confused me at first. Almost 40% of Broadcom's AI revenue isn't actually coming from selling those custom compute brains.
Yeah, that surprises a lot of people.
It's coming from networking. Why is connecting the chips almost as lucrative as the chips themselves?
It comes down to the physical laws of how AI models are actually trained. You cannot train a frontier AI model on a single computer chip.
You need a lot of them.
You need tens of thousands of them working together seamlessly as a massive unified supercomputer. And when you have 10,000 chips sharing petabytes of data, they have to communicate in fractions of a microsecond.
Or else the whole thing slows down.
Exactly. If the copper wire, the switch, or the optical laser connecting them has even a single millisecond of lag, the entire $100 million supercomputer sits completely idle, just waiting for data to arrive.
Ah, so it becomes a massive digital traffic jam. If the roads aren't wide enough, it doesn't matter how fast the cars are.
That's exactly it. Broadcom manufactures the technology, specialized Ethernet switches, the advanced optical lasers, the high-speed networking tech that prevents those traffic jams. They ensure the data flows instantly.
And the scale of these supercomputers has gotten so out of hand that Broadcom has fundamentally changed the metric they use to measure their sales. In the call, they repeatedly measured their sales not in units, but in gigawatts of power capacity.
Which is a profound shift in how we think about computing scale.
It really is. It reminds me of commercial real estate. Instead of a developer telling you how many individual houses they built in a new subdivision, they're telling you the total electrical grid capacity they had to install just to keep the lights on in the new city.
That's a great analogy.
The chips are getting so powerful, and they require so much energy to cool and operate, that counting individual pieces of silicon misses the whole picture. You have to measure the raw electrical power required to run the data center facility itself.
And that gigawatt metric directly informs Broadcom's overarching business strategy, which Hock Tan refers to as chips only.
Chips only.
Yeah. Many competitors want to lock customers in by selling the entire integrated ecosystem, the server racks, the proprietary software stack, the liquid cooling systems. Broadcom is perfectly content to just sell the highest quality individual components.
Like selling the parts instead of the whole car.
Exactly. They provide the raw picks, shovels, and copper wire to the biggest tech players on the planet, allowing those players to build and configure their data centers however they see fit.
So let's talk about those tech players, because Broadcom's client list is essentially a VIP room of the global economy. They announced a $30 billion backlog in AI bookings this quarter alone, giving them locked-in revenue visibility all the way out to 2028.
Is massive.
Who is actually buying all this gigawatt-scale hardware?
Well, they have 6 core custom chip customers, but the undeniable heavy hitters driving this tidal wave of revenue are Google, Meta, OpenAI, and Anthropic.
The big four.
Yeah, these are the companies building the foundational models that the rest of the software world relies on.
Hock Tan shared a really interesting anecdote in that Bloomberg interview about Anthropic specifically. A year ago, Broadcom and Google took what he called a leap of faith to supply Anthropic with massive compute power.
Right, before they were famous.
Exactly. This was long before Anthropic's valuation exploded and they became a household name. Broadcom basically bet early that enterprise generative AI, things like coding assistants and deep analytical business tools, would become a massive, lucrative market.
And that bet paid off beautifully. They didn't just sell Anthropic individual chips. They provided them access to a massive, dedicated cluster of Broadcom TPU-based compute.
It was a huge strategic move.
It was a highly strategic investment in a specific business model within the AI ecosystem.
But providing that compute at such an insane scale leads to what I think is the most surprising part of this entire earnings report.
The Apollo deal.
Yes, Broadcom is teaming up with private equity giants Apollo and Blackstone to create a new AI platform called AI XPV.
Yeah, this is huge.
The first tranche of this platform is valued at $35 billion, and the stated goal is to deploy more than 20 gigawatts of compute capacity through 2028. But I'm struggling to understand the logic here.
How so?
Well, is Broadcom suddenly trying to become an energy provider and a commercial real estate holding company? Why is a semiconductor designer partnering with Wall Street private equity?
It goes directly back to that real estate analogy you made earlier. The biggest bottleneck for AI development globally right now isn't manufacturing the silicon chips.
It's not.
No, Broadcom can design and stamp out the chips all day long. The true bottleneck is funding, permitting, and building the physical data centers.
Oh, wow.
Yeah, acquiring the land, securing massive water rights for cooling towers, and tapping into the local power grid with giant transformers just to house 20 gigawatts of compute.
So it really doesn't matter how fast Broadcom makes chips if their customers literally have nowhere to plug them in.
Precisely. And keep in mind, frontier labs like OpenAI and Anthropic are fundamentally software companies. They do not have tens of billions of dollars in hard physical capital lying around to build steel and concrete data centers. By partnering with Apollo and Blackstone firms with some of the deepest pockets and strongest balance sheets in global finance, Broadcom is actively helping to underwrite and construct the physical infrastructure.
Wait, so they are essentially acting as a bank or a real estate developer for their own customers.
In a way, yes.
They're arranging the financing for the data centers just so these AI labs can afford to buy and install Broadcom's chips. That feels dangerously close to creating a bubble if those AI software labs don't eventually figure out how to turn a massive profit.
It is a calculated risk, certainly. But having Apollo and Blackstone underwriting the physical assets drastically reduces the danger. Broadcom isn't carrying that $35 billion burden on their own balance sheet.
That makes sense.
They're just ensuring the road gets paved so they can sell their cars to drive on it. It's a brilliant way of uncapping their own demand constraint without taking on all the financial risk of construction.
But shifting toward all this massive physical hardware comes at a cost, which actually showed up as a weird anomaly in their profit margins this quarter.
Yes, the margin drop.
Gross margins dropped 230 basis points down to 77.1%. Now, when the average retail investor hears the phrase margins dropping, they usually panic and hit the sell button.
They do, but this is a perfect example of why you have to read the actual earnings call transcript and not just skim the headlines.
Exactly.
CFO Kirsten Spears explained this margin drop very clearly. It is not a structural flaw in their business or a sign of weakness. It is a simple mathematical quirk based on what products they are selling the most of right now.
Let me see if I can break down the math on this to make it clearer. It's like a bakery that sells highly decorated, high-margin wedding cakes, but also sells standard, lower-margin daily bread.
Okay, I like where this is going.
Broadcom's infrastructure software division, which has incredibly high margins, around 93% is the wedding cake. Their semiconductor hardware division, which has lower margins, around 70%, is the daily bread. Right now, because of the AI boom, they are selling an absolute mountain of bread.
That is a fantastic analogy. Because the 70% margin hardware business is growing so explosively fast, it is becoming a much larger slice of Broadcom's total revenue pie.
Right.
So mathematically, the average overall margin naturally gets pulled down. But it doesn't mean the chips themselves are becoming less profitable to manufacture. They are just taking way more total cash to the bank. Their operating leverage remained incredibly strong and stable at 67%.
And we shouldn't ignore those software wedding cakes either. They brought in $7.2 billion in infrastructure software revenue.
A huge number.
Yeah, and a major chunk of that comes from VMware, which Broadcom recently acquired. They just released VMware Cloud Foundation 9.1, and it is driving a 17% growth in annual recurring revenue.
That annual recurring revenue, or ARR, is vital for stabilizing Wall Street's nerves.
Why is that?
It represents predictable, subscription-based cash flow. Software subscriptions act as a financial shock absorber against the notoriously boom and bust cyclical nature of selling hardware.
But even with that software shock absorber, there is a massive risk hanging over their custom hardware model. Bloomberg pressed Hock Tan hard on this point in the interview.
Oh, the Google threat.
Yeah. Google is a massive customer for Broadcom's custom TPUs, but Google is openly trying to design its own chips internally to save costs. They call it customer-owned tooling. If your biggest client figures out how to make your product themselves, aren't your days numbered?
It is a very real threat to their revenue stream. But Hock Tan has been in the semiconductor business for over 2 decades, and his philosophy on this is fascinating.
What do you say?
His response to Google trying to build their own chips was essentially just out-engineer them.
I genuinely laughed when I read that quote. It's just so blunt. But I mean, how do you casually out-engineer one of the most powerful and well-funded tech companies on Earth?
Because Broadcom's perspective is that Google is trying to match the absolute gold standard of AI compute from scratch.
Yeah.
To do that, Google needs Broadcom's deep intellectual property, their decades of networking expertise, and their ability to iterate complex designs across multiple product generations quickly.
They have a huge head start.
Exactly.
Okay.
Broadcom is betting their dedicated engineering teams will always stay one step ahead of a customer's internal side project.
And they have a secret weapon to stay ahead. Hock Tan mentioned they use an internal AI tool called Opus 4.7.
Yes, Opus.
He said that with this tool, one highly trained senior engineer can produce a complex application design in just 1 week that would normally take 10 engineers 3 months to complete.
That blew my mind.
Right. In the semiconductor world, time to market is everything. If they can compress 3 months of engineering into 1 week, that's not just saving money on salaries. That is literally the mechanism of how they beat Google to the next generation of chips.
The unit economics of that internal efficiency are staggering. It is a beautiful, self-reinforcing cycle. Broadcom uses AI to design better chips faster, so they can sell better chips to run more AI.
It's a flywheel.
It really is. And because this organic cycle is generating so much profit, I mean, they are pushing organically toward $50 billion a year in revenue. It has completely shifted their corporate strategy.
How so?
Well, Broadcom is historically famous in the tech world for aggressive mergers and acquisitions. But Tan told Bloomberg they are actively avoiding M&A entirely right now.
No more buying companies.
Not right now. They don't need to buy shiny new companies to find growth. They are far too busy managing the explosion of demand they already have in-house.
Wow, we have covered a massive amount of ground today. Let's pull back and summarize this deep dive.
Good idea.
If you're trying to make sense of this mountain of data, here are the core takeaways. On the financial side, Broadcom is an absolute cash-generating machine.
Unstoppable right now.
They are seeing historic revenues and massive operating profits driven by an insatiable global demand for AI. The stock market may have thrown a tantrum because they wanted even faster forecast upgrades, but the underlying fundamentals of the business are incredibly robust.
And looking at the tech and strategy, Broadcom is completely dominating in custom XPUs and the critical networking infrastructure that prevents data traffic jams.
The digital highways.
Right. They have shifted the paradigm away from counting individual chips to measuring their success in gigawatts of raw power capacity. They are selling the bespoke picks, the shovels, and the copper wire for the AI gold rush.
And finally, the challenges. They are navigating a totally normal gross margin shift as their hardware sales dramatically outpace their software sales.
Wedding cakes versus the bread.
Exactly. They have to constantly out-engineer massive clients who want to build their own silicon. And perhaps most importantly, they are having to act almost like real estate developers, coordinating with private equity giants like Apollo and Blackstone to finance the ultimate bottleneck global power and physical data center limits.
Whether you are a tech enthusiast, a market investor, or just someone trying to wrap your head around this AI boom, Broadcom is the ultimate bellwether.
They really are.
We spend all our time talking about software models like ChatGPT or Claude, but those models don't exist in the ether. If you want to know where AI is truly going and how fast it can actually get there, you have to follow the companies laying down the physical copper, the lasers, and the silicon.
The physical reality always dictates the software's potential.
It does. And that brings up one final provocative question to leave you with, based on something Hoktan mentioned regarding AI tokens.
Oh, yeah. This is interesting.
Right now, this massive demand for gigawatts of power is being driven by just a handful of frontier labs building these foundational models.
The OpenAIs, the Metas, the Googles of the world.
Right. But think about the near future. What happens to the global power grid and to Broadcom's gigawatt scaling when everyday enterprises and billions of consumers start generating billions of daily AI transactions or tokens for completely mundane tasks? Like writing emails, analyzing local spreadsheets, coding basic internal business apps. Will the physical infrastructure, the actual power grid of the country, be able to handle a world where every single company runs continuously on custom AI tokens?
That is a wild thought to end on. The software might be ready for the future, but the electrical grid might not be. We will have to wait and see how that bottleneck plays out. Thank you so much for joining us on this deep dive. Keep asking questions, keep looking past the headlines, and we will catch you next time.